to fill in all of this from line C and line D up here. So we know that equipment was sold for cash. So we have cash received from sale of equipment. Excuse me. 24,800. And we have cash received. Whoops, Gcash. Cash received from sale of machinery as well. And that amount is 45,200. And then we have the cost of new merchandise or new machinery purchased. So cash paid for machinery right there. And so that's a cash outflow of 21,000. And since that's all of the long-term assets we have, we know that we're done. So we can calculate the balance of that as well. Give ourselves a place to put that heading. 24,800 plus 45,200 minus 21,000. A net increase in cash of 49,000. So now we can pick the heading net cash inflow from investing activities. Then we have cash flows from financing activities, and so that includes the dividend effect, the long-term notes payable, and the share capital effect. So let's start with dividends. Give ourselves a little bit more room here. Actually need one more line, but we'll pop that in a second. So we want dividends paid. Probably cash paid for dividends. Yes, there we go. Cash paid for dividends. It's going to be the amount of the dividends, 49,000, which is right here. It says dividends paid during 2015 were 49,000. Now we could do the reconciliation for retained earnings, and it would work out the same, but we're not going to do that. So then the next item is long-term notes payable. We have information up here that says 13,000 of the long-term notes payable will be paid during 2016, but as we discussed before, that doesn't impact the cash flow statement. But we have reduced the value of the long-term notes payable from 89 down to 71. So that would be cash paid on a long-term note. Whoops, not on issuing capital. That's a different line. We want cash paid on long-term note. That's the one we want. So once again, we can do the calculation like this. We paid 89,000, and then we borrowed back 71,180. So the net impact is 1,780. Cash paid is consistent with that. So that takes care of the long-term notes payable, and we've already dealt with retained earnings because we have net income and dividends all there. We could check it if you would like. Let's just quickly do that. Our opening retained earnings is 69,000, and then we added net income up here of 20,000. And then we subtracted dividends of 49,000. That works out to 40,000 as a closing balance. Something's not, where did my, is that what I want to do here? Oh, I think I'm leading you astray here, because the 69,000 is actually the opening balance from 2014. So we need to put in, okay, forget, let's just ignore that. I'll delete the conversation entirely. So scratch that from the record, as they say in the court dramas on TV. The problem is that this 78,000 is the opening balance, and we don't actually have a closing balance in retained earnings. So until we actually close all the accounts, we don't have the closing balance number. So there's no dividends payable. If there's no dividends payable at the opening and closing balances, then we know that all of the dividends were declared and paid during the period. And it kind of says that in F here. It says cash dividends were declared and paid. Okay, one last item, the share capital. The share capital is increased by 204 to 244. It says in paragraph E up here, share capital was issued for cash. So that means that cash would have been coming in. And so cash received from issuing share capital right there. And so once again, it's on the liability side. So we paid off the 204, and then we borrowed another 244. So the net impact is an increase in cash of 40,000. Okay, last summary we need to do here, 49,000 minus 17,820 plus 40,000 gives us a net cash. Oh, this number should actually be negative. That would make a difference. Okay. So we have a negative 49,000. That makes a little more sense. Okay, so the cash was paid for dividends. Cash was paid on a long-term note. Cash was received from issuing share capital. So we have a net cash outflow. So click on headings and totals. Find net cash outflow from financing activities, and there we are. Now let's add those up and see what we get. 41,800 plus 49,000 minus the 26,820 used in financing. So that says that the net balance, net increase or decrease, is an increase of 63,980. Now the two cash items here, we've got cash opening of 250,000. You can grab that and drag it down here. Didn't apparently work for me, but you can grab it and drag it down. There we go. And grab that and drag it down as well. So the 2014 balance is the beginning, the 2015 balance is the end of year. Now we should check to see whether that actually reconciles. So we can do that right here. If we take, well, let's just take 63,980 and add that to 250,000. And that does work out to 313,980. So it does indeed reconcile, but make sure you don't leave that because Lyrics will complain about it. But it looks like everything is done here. It's a good idea to check to make sure you've got the title. And then it says cash flow from operating activities. And then the subtotal or the total down here is net cash inflow from operating activities. This is an increase in cash, so that's an inflow, so that is consistent. Cash flow from investing activities heading. Net cash inflow from investing activities total. So it's investing activities, and we've got a positive number here. We've got inflow there, so that's good. From financing, we've got from financing, and the financing is actually a cash outflow. It says cash outflow, so we're good there. It all reconciles. I think we've done everything we can. Let's see what Lyrics thought of our work. If we scroll down, Lyrics liked what we did, so therefore we're done.